to you by UBA Ghana Limited. We are doing this to support our businesses, our colleagues who are running business, and ensure that we can help to grow your business and make sure that we'll continue to enhance the value that we bring to you as a bank. My name is Henry Nidoti, and this morning we're going to have a conversation on understanding Ghana's tax regime as it relates to SMEs. And we have a very wonderful guest who's going to help us this morning. He is an assistant commissioner at the Ghana Revenue Authority, and he heads the Domestic Tax Revenue Division Technical Training Unit. Wow, he's a big man. He is a lecturer at the Ghana Revenue Authority Training School and provides training on for GRA staff in the fields of income tax and tax administration. He has over 20 years working experience with the Revenue Authority and vast knowledge in both domestic and international tax laws. Our facilitator this morning is also a lawyer by profession. He studied for his Bachelor of Laws program at the University of London and the Masters of Law program, and has a legal practice course from the University of Laws in the United Kingdom. He also studied international tax laws from the University of Leiden in the Netherlands and taxation of oil and gas from the University of Dallas in the USA. He also studied taxation of international transactions from the Malaysian Tax Academy and advanced tax treaty issues from Korean Tax Policy Center. He is a proud product of the Kwame Nkrumah University of Science and Technology, the Ghana Institute of Management and Public Administration (GIMPA), and the Central University College. He served as a resource person and a panel discussant on numerous tax seminars and workshops in Ghana and abroad. Ladies and gentlemen, our facilitator this morning is Lawrence Hochunyame. I hope I got the name right. Lawrence, you're welcome to the UBA Ghana Business Series.
Thank you, my brother. How are you?
We're doing well, and thanks very much for taking time off your busy schedule to be with us. You play an important role in shaping the human resource base of the Ghana Revenue Authority to ensure that we are able to administer tax in this country, where that brings value to Ghanaians. So, I mean, we're happy and excited to have you here. Let's have your opening remarks for joining us this morning as we talk about tax administration or alternative tax regime relating to the SME space in Ghana.
All right, Harry, thank you very much. It's much valued for GRA to have this interaction. Once in a while, we engage the public. You know, one of our core functions or one of our core mandates in GRA is to educate our tax-paying public. And so we cherish this opportunity. We think it's an opportunity for us to explain some of the things we do, and then the legal basis for which we do those things. And then we also expect that our cherished taxpayers will use the opportunity to clarify some few confusion on their minds. And so this very welcome platform, and we're hoping that, it will be a very fruitful discussion. Basically, it's about understanding the Ghana's tax regime. And that's what we are set to do this morning. And these are my initial remarks, my brother.
I was going to share a quick presentation with us on the tax regimes. I've seen it very exciting. And so look forward to an engaging section. And then we'll have opportunity. Please drop your comments and your questions in the chat. Send your questions to us as it goes along, and then we'll bring all of them to you. So Lawrence, if you are ready, let's bring up the presentation, and then we'll share the presentation with our audience. And then at the end of the presentation, we'll take questions. Please drop your questions ahead in the chat session, and we will put them to Lawrence to give us some answers as we go along.
All right, thank you very much, Henry. Basically, this morning we're going to walk through some few areas of taxation. We'll be looking at the laws that are administered by GRA, the obligations of the taxpayer. We'll be looking at some of the income tax issues. I'll be looking at some of the income tax issues, the temporary concessions for some sectors of the economy. We'll be looking at withholding taxes. What is it about? We'll also be looking at payroll taxes and some personal reliefs. And then we'll look at some issues relating to value-added tax and then some computation. Basically, that's going to be the outline of our presentation. We all know that GRA, by an Act of Parliament, Act 791, was established in 2009 and has been the sole organization or institution mandated by law to administer all the tax types in Ghana. Before the coming into force of GRA, the taxes were administered by the erstwhile revenue agencies, the erstwhile VAT, erstwhile SEPS, and then erstwhile VAT service. By effective 2009, Act 791 gave birth to GRA, and we are solely responsible for the administration of all taxes in Ghana. GRA is made up of three divisions: the Customs Division, the Support Services Division, and the Domestic Tax Revenue Division. So that's the structure of GRA. To say that taxation basically is a creature of statute. And so in GRA, everything that we do is backed by law. You don't administer taxes outside a statute or a law. And so there are several laws that were passed by Parliament that governs the day-to-day administration of taxation in Ghana. Some of the laws that are fully administered by the GRA are those that are showing on our slide. We have the Communication Service Tax Act that governs the communication service taxation. Then we have Customs Act, Act 891, that governs the administration of customs and import duties. We have Customs, Excise, Petroleum Tax, and petroleum-related levies. We have Excise 2014 Act 878, basically responsible for the administration of excise duties in Ghana. Then we have Excise Tax Stamp Act, and that is an amendment to 878. That is Act 873. Then we have the Almighty Income Tax Act 2015, Act 896, that governs the administration of income taxes in Ghana. We have National Fiscal Stabilization Levy Act. That act was repealed this year. The National Fiscal Stabilization Act was repealed this year and replaced with Growth and Sustainability Levy Act 2023, Act 1095. Then we have the Revenue Administrations Act, that's responsible, or the act that governs the administration of all the tax types. And then we have the Special Import Levy Act, the Special Petroleum Act, Stamp Duty Act, the Value Added Tax Act, the COVID-19 Levy Act, and then the Financial Sector Recovery Levy Act. So these are several laws that governs tax administration. And everything that we do in GRA, we need to situate it within the context of these pieces of legislation that I've walked you through. Now, to continue with the presentation, all our cherished taxpayers have some obligation to GRA. And it's very important that we walk you through your primary obligations. All taxpayers, individuals, companies, trusts, partnership, all entities have this primary obligation. One, to register with GRA. You have an obligation to register with GRA. All our cherished taxpayers have also a primary obligation to file their tax returns on due dates, pay the taxes on due dates, and make full disclosure, correct disclosure of their business. Basically, we expect all our taxpayers to comply with these primary obligations: registration, filing, payment and then making a full disclosure. When it comes to registration, we have two layers of registration. We have the TIN registration and the tax type registration. Currently, for all individuals in this country, we're using our Ghana card number as our TIN registration number. So for all individuals, companies still have their TIN issued from the Registrar General's department, but all individuals currently have their Ghana card number as their TIN, as their tax identification number. And that has to do with the TIN registration. Then the second class of registration is the tax type registration, depending on the class of income that you earn, depending on the activities that you carry out. You may end up registering for personal income tax, corporate income tax. You may end up registering for withholding tax, VAT, depending on which income you earn or which activity you carry out. So that's the registration with GRA. The second obligation is an obligation to file returns, and it is mandatory for all our taxpayers to file their returns, make a declaration of what is going on in your business. The good news is that as we speak currently, GRA has fully rolled out its online filing portal. So you can do your tax filing online. You don't need to walk to any GRA office to be able to file. You just go to the taxpayers portal, you go to the filing of returns, you log in, and then you upload your returns, or you complete your returns on the taxpayers portal. The importance of filing returns is that it helps the Commissioner General to accurately determine your tax liability. And it also helps the Commissioner General to grant you whichever reliefs or rebates you are entitled to. When you are a taxpayer, you are entitled to a refund. You can only claim a refund if you have filed your tax returns. And then for those who qualify for other tax rebates and tax incentives, filing of returns makes it possible for you to be able to derive any benefits from the rebates or the incentives that are available to you as a taxpayer. When you fail to file your returns on due date, the Commissioner General will determine your assessment using his best judgment. And that is the challenge that we have with most of our taxpayers. Any taxpayer that fails to file his or her tax returns on due date, the Commissioner General is empowered under the Revenue Administration Act to assess the taxpayer using best judgment. And sometimes the best judgment of the Commissioner General may not be, too. So that is why it is important that all our taxpayers would have to file returns. When you fail to do that, you are indirectly telling the Commissioner General to use his best judgment in raising an assessment on you. And then the Commissioner General can also impose penalties when you fail to file returns on due date. Now, the base amount is 500 Ghana cedis, which is equivalent to 500 currency points, plus 10 cedis for each day that the default continues. That's the penalty for failure to file returns on due date. And so the second obligation is that all our taxpayers are under obligation to file their returns on due dates. The corporate income tax returns, for example, is filed 4 months after the end of the business period of the taxpayer or the accounting year. The PIT returns is also filed 4 months after the end of the accounting year or the business period. The withholding tax returns is filed 15 days after the month in which the tax was withheld, and so on and so forth. So we expect all our taxpayers to comply with this obligation. The third one is voluntary tax payments. We do not expect that GRA officers should chase our taxpayers before the taxes are paid. We expect voluntary compliance. We expect voluntary compliance. And all the taxes that we are going to talk about are paid, have due dates for payment. So, for example, when it comes to the corporate income tax or the personal income tax, it is paid on quarterly installment basis. So for corporate income tax and personal income tax, the taxes are paid on quarterly installments. So for example, if your assessment for the year is 100 Ghana cedis, then it means the first quarter, which is January, February, March, you pay 25 cedis. The second quarter, you pay 25 cedis. The third quarter, you pay 25 cedis. And the last quarter, you pay 25 cedis. And most of these assessments are self-assessment. You determine the liability yourself. You raise the assessment on your own projected incomes. And so for those that pay taxes on quarterly installment basis, you don't need to wait for anybody to come to your shop or your office to pay. If your self-assessment for the year is 40,000 Ghana cedis, it stands to reason that for each quarter, you subtract 1,000. The second quarter, 10,000, the third quarter, and the last quarter. When it comes to withholding taxes, they are paid within 15 days after the end of the month in which the tax was withheld. So all withholding taxes, we'll be looking at withholding taxes. You don't pay it on quarterly installment. For withholding taxes, you pay all withholding taxes within 15 days after the end of the month in which the tax was withheld. And then for VAT, it's paid within the last working day of the previous month. So the previous month's payment has to be paid within the last working day of this month. And currently, all our payments are done at the various commercial banks. So you don't need to walk to any GRA office to go and make payment. You can just walk to any of our commercial banks and you can effect payments at the counter. And then you can also make payment on the Ghana platform. You just dial www.ghana.gov platform and you can make payments online. So now let's talk about income tax. Like I indicated earlier, the law that governs the administration of the income tax is the Income Tax Act 2015 at 896. That is the law. And in that act, income has been classified into three: employment income, business income, and investment income. To any of these three classes of income, you are liable. I repeat again, under the Income Tax Act, the law classifies income into three categories: employment income, business income, and investment income. And any person that earns any of these three classes of income is liable. So employment income basically is gains and profit from employment. And it includes salaries, wages, allowances, bonus payment, overtime payment, or any benefit in kind that is attributable to your employment. So anything that you receive in respect of your employment, which is a gain or profit, the law says you should be subject. Section 5 of the Income Tax Act relates to business income. To trading activities, trade, profession, or vocation. That is how business is defined in the law. Are you engaged in trading? Are you a professional? Are you engaged in vocation? That all such activities are classified as part of business. So when you charge service fees for rendering a service, you are earning a business income. Receive consideration in respect of your trading stock that you sold, you are engaged in business. And all such incomes are supposed to be disclosed for tax purposes. Investment income is the third class of income. So the law gives specifics when it comes to investment income. Interest. So when you receive an interest income, that income is an investment income. Dividend income is an investment income. When you own a property and you rent out the property and receive a rent income, that rent income is an investment income. Royalties income is an investment income. Lottery winning of lottery or winning of lotto is an investment income. And then investment gift, a gift received in respect of investment, is also an investment income. So somebody gave you shares, or somebody gave you bond or stock. It's an investment income. Natural resource payments are all examples of income. And the law says that any of these three classes of income, you are liable to tax in Ghana. So our taxes are based on the residency rule. The income taxation in Ghana is based on residency rule. So the question that should be asked is whether your company is a resident company or a non-resident company, or if an individual is a resident individual or a non-resident individual. That is the question that needed to be answered. These are the things that defines the rules of taxation. So for a resident entity, for example, we tax their income from the worldwide source. That is the rule regarding taxation of a resident company. So if your company is a resident company, like UBA Ghana Limited, we expect that when you are filing your returns at the end of the year, or you are disclosing your income at the end of the year, you disclose your income worldwide source. And that is the rule regarding resident entities. For non-resident entities or non-resident individuals, it is only income that has a country that we tax. Non-resident company, it is only income that have a source in this country to taxation. And then we have something we call a permanent establishment of a non-resident company, a non-resident person. So the company is in, let's say, Sweden, is incorporated in Belgium, but they have a business presence in Ghana. Business presence is called a permanent establishment. And they are taxed. Those permanent establishments are taxed in Ghana, and it is taxed on a worldwide income to the extent that that income is effectively connected to the permanent establishment. So there are three categories of persons identified by the tax law. A resident company or a resident entity, basically it's an entity that is incorporated under the laws of Ghana. A resident entity is an entity that is incorporated under the laws of Ghana, and such entity, their income is taxed from a worldwide source. But for companies or entities that is elsewhere and have their effective management exercised elsewhere, it is only the income that has a source in Ghana that is subject to tax. Therefore, permanent establishment income that is effectively connected, permanent establishment is subject to tax in Ghana. When it comes to corporate profits, the corporate two levels. The profit is to a corporate tax rate, and then the tax, which is distributed, is also taxed in the hands of shareholders. When it comes to partnership, we do not tax the partnership as we tax the partners' partnership. So it is those partners who form the partnership, they are of tax, not the partnership as an entity. So that's about taxation of partners of a partnership. The rates for corporate income tax, the general corporate income tax percent. That's the general corporate income tax rate. But when it comes to mining and extractive industries, their rate is 30%. Hotel industries paid a reduced rate of 22%. And companies that are engaged in non-traditional exports are subject to tax at the rate of 8%. The banks that lend to farming or leasing companies, granted to leasing companies or farming business, are subject to tax at the rate of 20%. Manufacturing businesses enjoy what you in tax incentive where the manufacturing business is. For example, if the manufacturing business, the regional capitals, they are 25%, and corporate rate reduced to 75%. Where a manufacturing company is located, maybe in the towns or cities, regional capitals, they enjoy 50%, and for that matter, it comes down from 20 to 12.5%. So all businesses in Ghana enjoys what we call tax incentives, depending on located. So, for example, manufacturing company is in Suhum region, that manufacturing tax at a rate of 12.5%. Where if a manufacturing company is located in a, that company will be subject to tax at percent. So depending on the manufacturing company, you are entitled to rebates. So the question, the tax for income tax purposes. For income tax purposes, is the assessable income. When your assessable income from employment, business, or investment, your assessable income together, then what we call the allowable deductions. Deductions, legitimate business that are entitled to. So the allowable deductions, we arrive at taxable income, and then taxable income at the appropriate rate. So that's how we calculate the taxes. The overall assessable income, gross income, we take out expenses, then we the chargeable income, and then we tax income. Our tax losses are allowed to be carried, business losses are allowed to be carried forward for effective 3rd April 2023. All business losses are allowed to be carried forward. The laws, the tax law permits you to carry forward that loss for the next 5 years. Before April 2020, we have two sectors. We have what we call the priority and all other sectors. The priority sector carry forward losses for 5 years. Other sectors carry forward losses for 3 years. But effective 3rd April 2023, all businesses can carry forward losses for 5 years. So this is just a demonstration. The procedure, like I indicated earlier, assessable income, we take out deductions and we arrive at your chargeable income. So the tax is calculated on your chargeable income. The tax is calculated on your chargeable income. And all these the terminologies are defined by law. The assessable income is defined by law. The allowable deductions are specifically defined by law. And then the chargeable income is also defined by law. So this is not just English language we put together. Everything that's the method of calculating the tax or the chargeable income is prescribed by law. So for example, if your assessable income is 1 million and all your allowable deductions, legitimate deductions, total 250,000, that's 250,000, then your chargeable income will be 750,000. Basically, it's about that. The allowable deduction is 250,000, so we'll edit the last zero. So if your assessable income is 1 million and all your allowable deduction is 250,000, for example, then your chargeable income will be 750,000, and then the tax will be calculated on your chargeable income, which will be 25% of 750,000, and that will give us what? 187,000. This is a typical example of a company that has made losses. So your 50,000. So you nil. And the loss is that the tax made can be carried forward for the next, like I indicated earlier. Capital gains. Basically, capital gains.
What is happening
A
right now
person
is a presentation by Mr. Lawrence Hucho Nyame, who is talking to us about understanding Ghana's tax regime relating to SMEs. And we've learned a lot of things about chargeable income and how tax is computed. He's continuing with capital gains. Lawrence. You may
Yeah.
continue.
All right. Thank you very much. What is capital gains? Basically, it's a gain of a capital asset. For example, is land. When you sell a land and you make a gain on the land, maybe you bought the land 100 cedis and you sold the land at 150 cedis, you have made a gain of 50 cedis. That gain is what we are referring to as capital gains. Or maybe when you have a building, that building is an investment asset. For example, you bought the building at 1 million, maybe 5 years ago, and you sold the building at 150 million. You've made a gain of 50 million, and that 50 million is part of your business income. In actual fact, the law says that the gains from the realization of a capital asset should be treated as part of your business income and tax. So when you are a company and you dispose of any capital asset or any investment asset, and you made a gain on the realization, the law says that that gain should be added to your business income and tax. So you dispose of land, you dispose of shares, acquire the shares, maybe the value of the shares was about 100 million. Then at the time of disposing of the shares, the value, the consideration received is 120 million. It means you have made a gain on the 20 million. And that 20 million business or investment income. When it comes to individuals, when you sell any of these things and you made a gain, the individual could elect that gain should be subject to tax at the rate. The current when an individual's elect is 25, but before 3rd April 2020, individuals could tax their capital gains at 15%, but the current rate is 25%. So once you made an election as an individual, that gain will be subject to tax at the rate of what? 25%. There are several businesses that enjoy tax concessions or tax holidays, and some of them are agribusiness. The agribusiness are classified into cash crops, fish farming, livestock farming, crops, cattle farming, and so on and so forth. And all of them enjoy some tax holidays or tax concession period. For cattle and tree crops, they enjoy a tax holiday period of 10 years. And during the 10-year period, your chargeable income is taxed at the rate of 5%. The rate used to be 1%, but effective 3rd April 2023, that rate has been revised to 5%. So during the tax holiday period, your chargeable income is taxed at the rate of what? 5%. But those before 3rd April 2023, the chargeable income is taxed at the rate of 1%. It's currently 5%. All other agribusiness, cash crops, fish farming, and livestock, all of them have a tax holiday period of 5 years. The first 5 years is subject to tax at the rate of 5%. And then after that, you go to what we call a location tax incentive. And then you go back to your normal, regular, graduated rate or corporate rates. Businesses that are into the processing of cocoa byproducts, cocoa byproduct business, they have a tax period of 5 years. So for the very first 5 years, income is taxed at the rate of 5%. And then after the 5-year period, what we call the location tax incentive. After the location tax incentive period, normal rate of either 20 company or graduated rate if you are an. Then agro, they also enjoy a tax of 5 years. During the 5, your chargeable income is taxed at the before it was 1%. If 3rd April, the current rate is 5%. And they also enjoy a location incentive of period, which prescribe reduced rates, and rural banks. All rural banks enjoy a tax concession period of 10 years. In the concession period, your charge is at the rate of 5%. Rural banks, companies that are waste processing, for example, Zoom Lion, processing or recycling of waste, and so forth, they have a 7-year period. And during the 7-year period, from the year of commencement of business, the charge is 5%. That are engaged in the construction for sale and letting of low cost affordable, they have a 5-year period. And during their chargeable income is taxed at 5%. 3rd April 20, but before 3rd April 2020, it was 1%. To venture capital financing companies, they have a concession period of 10 years. 10-year period, they are at the rate of 5%. Then we have other things which is applicable for companies that employ fresh graduates. Fresh graduates. Percentage of fresh graduate made up your workforce. Their wages and salaries, a percentage of their wages and salaries can also be granted to you an allowable deduction. There is some concession there for companies that employ fresh graduates. One, you are entitled to claim their wages and salaries that you pay them as an allowable deduction, which will reduce your chargeable income. And then you are also entitled to a percentage of their total wages and salaries as an additional allowable deduction. Importers and exporters of exercisable goods they enjoy what we call 2 years accelerated depreciation on the machines that they use to fix the tax stamp. So all importers and exporters of exercisable goods, all the machines that are imported are granted what we call an accelerated depreciation for 2 years. The first year we grant you an accelerated depreciation of 50%, and the second year we grant you the rest. So that's also a concession that is available to them. Entities that are engaged in the manufacturing of automobiles in Ghana, so companies that are assembling vehicles and so on and so forth, have some concession. So we have two classes of them. We have what we call the semi-knockdown vehicles and the complete knockdown vehicles. Knockdown vehicles is, you bring in the parts and you just come and assemble. And for 3 years, for the very your income is exempt, you start paying taxes. And complete knockdown vehicles bring in all the or to put together the key component of the vehicle, and they have an exemption period of 10 years. So if you are doing a complete knockdown, you have an exemption period of 10 years. And if you are doing a semi-knockdown, you have an exemption period of 3 years. Then our young entrepreneurs are granted what we call an exemption period of first 5 years. But the young entrepreneur must be an individual below the age of 35 years. And those individuals who are engaged in business or investments are entitled to exemption for the first 5 years. And after the 5 years, they go on what we call the location tax incentive, depending on where they are located. But that individual must be engaged in some specific businesses. For example, creative art, horticulture, medicinal plants, ICT, and so on and so forth, agro-processing, farming. So they are selected businesses that the exemption covers. Then our private investees enjoy some conditional exemption. The condition is that they plow back 100% of their profit after tax. Once they are able to establish that they have plowed tax, then they enjoy some exemption. When they fill that condition, then the income of the private investor becomes taxable. The free zone companies, when it comes to their corporate income tax, the corporate income tax, the very first 10 years is exempt from tax. Companies covered under income under the Free Zones Act, the very first 10 years from the date of commencement of your business, the free zone companies are exempt from corporate first 10 years. 10 years, when you export, the export goes for a rate of 15%, but when the market, it goes for a corporate rate of or free zone when it comes to corporate income tax. Holding taxes. There are a list of payments that suffered withholding taxes. One of them is dividend. Withholding taxes basically are taxes that are deducted at source. They are taxes that a withholding agent is required by law to deduct at source and pay to GRA. So the law specifically lists the payment that should be subject to withholding. So what we're going to do is to walk through the payments. That when you make this payment, it should be subject to withholding. When you make this payment, and all companies in this country, every company that is incorporated under the laws of Ghana is a withholding agent. So there's an obligation on you that when you are doing business with third parties, you are under obligation to withhold. And all entities are also obliged to withhold when they are doing business with third parties. Those entities, whether they are charitable organizations or partnership or whichever entity, the law imposes obligation on you to withhold when you are making payment to your third parties. So the first one is dividend. Dividend is payment that companies make to their shareholders. So when you make dividend payment to your shareholder, the law says that it should be subject to withholding at the rate of 8%. Resident companies, and one is the other, and one resident 25% or more of underlying ownership of the other, dividend payment between the two resident companies, that is the only exemption when it comes to dividend. But other than that, dividend that is paid to all shareholders, once you pay dividend to shareholders, the law says it should be subject to withholding at the rate of 8%. Whether the person you are paying to is a resident person or a non-resident person. Interest. Interest is also subject to tax at the rate of 8%. Interest. So there are lists of interest that are exempt, I'll take you through. But any interest that is paid to a company, interest payment to a company, it's subject to withholding at the rate of 8%. Interest payment is subject to withholding at the rate of 8%. Then these are examples of interest that are earned from tax. When the interest is paid to an individual by a resident financial institution, so UBA, for example, paid interest to an individual, pay interest to me, that interest is exempt from tax. Any interest on bond issued by government of Ghana, treasury bills, any interest from treasury bills or any bond issued by government of Ghana paid to an individual is also exempt. The key word is that that interest should be paid to an individual. Then interest or dividend paid to or a holder of an approved unit trust is also exempt from tax. Interest paid to non-resident person on bond issued by government of Ghana. So if the government of Ghana issued any bond and that bond is subscribed by a non-resident person, any interest payment to that non-resident person is exempt. A gain from a realization of a by government of Ghana to a non-resident person is also exempt from tax. So these are classes of interest payments that are exempt. Royalties. Royalties basically is an royalty. So when you property and you give another person the right to use that intellectual property, payment in respect of the use of that intellectual property, the payment is referred and royalty is subject to it at the rate of 15%. It is subject to withholding tax at the rate of 15%. And then the recipient of the royalty, if it's a resident person, then the royalty income, and that income will be taxed at the corporate rate of 25%. So royalties are taxed at two levels. At the time that the user of the intellectual property is paying the royalty, whether to a resident person or a non-resident person, it will be subject to a withholding of 15%, after which the recipient of the royalty income will have to disclose it, and that will be taxed at 25%, and then the taxes that are deducted as source will be granted to the person as a credit. Technical service. The technical service, basically those non-resident persons that comes to Ghana to perform consultancy services. We call them management and technical services. Their withholding is 20% final. Rent is taxed at two levels. When you rent a property and you are using it for commercial purpose. When you rent a property, you are a tenant, and you rent a property and you are using it for a commercial purpose. When you are making payment to the landlord, you would have to withhold tax at the rate of 15%. But when individuals are withholding and the property is a non-residential property, the withholding is 8%. So the withholdings, rent 15% for commercial, interest 8%, dividend 8%, final royalties 15%, natural resource payment 15%, lottery winning 10%, and then the law introduced some other withholding regarding the realization or the sale of property. When you dispose of property like a land or a building, on the consideration received, the consideration to withholding at the rate of 3% if the person selling the property is a resident person. But if the person selling the property is a non-resident person, then the withholding is 10% final. Let me take that one again. It's a new provision. When of any immovable property, land, either a capital asset or an investment, the person who is, if you are the one buying, you are going to find out whether you is a resident person. If the resident person and you are making, then you withhold at the rate of 3%. But if the person selling the land to you is a non-resident person, of 10%. So there's withholding on realization immovable properties. There's a withholding on realization of immovable. Other withholdings are fees and allowances paid to resident directors. It's 20%. Those who are operating as private investors or private, their withholding is 10%, 10% final, and percent endorsement. Those who fee, you are either endorsing, paying you for endorsing his or product or service is required to withhold 10%. Commission on lotto receivers is 10%. Canvassing agents 10%. When the supply of goods in this country, the withholding is 3%. The only exemption is where the goods in question constitute a trading stock for both the vendor and the purchaser. The supply of service is 7.5%. Supply of works, all contractors, the supply of works, the withholding is 5%. So these are the various withholdings that are applicable when making payment to third parties. When it comes to supply of goods, works, or services to non-resident persons, is 20% across board. But when you are doing it to a resident person, supply of goods, the withholding is 3%, supply of service is 7.5%, and supply of works is 5%. But any payment to a non-resident person is 20% across board. So when you are making payment to a non-resident person for a supply of goods, supply of service, or supply of works, is 20%, 20%, 20%. Now let's look at how individuals are taxed. Like I said, individuals, once you earn employment income, business income, or investment income, that income is taxed. And the income of a resident individual is also taxed from a worldwide source. So we tax your income from a worldwide source. The income of an individual is taxed using the graduated rate. So this is the current graduated rate. I'll share the slides. So this is the current graduated rate. This is the rate effective 3rd April 2023. So these are annual rates. So any chargeable income of 4,824 annually is not subject to income tax. The next 1,320 is subject to income tax at the rate of 5%. The next 1,560 is subject to income tax at the rate of 10%. The next 36,000 is subject to income tax of 17.5%. The next 196,740 is subject to income tax at the rate of 25%. The next 359,000 is subject to income tax at the rate of 30%. And any income, annual income in excess of 600,000 is subject to tax at the rate of 35%. So this rate is applicable to all individuals, whether that individual is a sole proprietor or an employee, partner of a partnership. Individuals, we apply the graduated rate are used. These are annual rates. The next slide will give us the monthly rates. 40 on a monthly basis. First 402 is nil, 110 is taxed at 5%, 30 is taxed at 10%. The next 3, and any monthly income in excess of 50,000 is taxed at 35%. So you realize that this is progressive. It is progressive rate. The higher your tax and the lower your income, the lower your tax. Personal reliefs. All resident individuals are entitled to these reliefs. Marriage and responsibility relief. Currently, the marriage and responsibility relief currently is 1,200 annually. The child education relief, any of your children or your wards who is in school from nursery to university in Ghana, each of your children or your child or your ward is entitled to a relief of 600 Ghana cedis, and you are entitled to a relief up to a maximum of 3 children. So the total relief that you can claim in respect of your children is 1,800 if you have up to 3 children, and that's an annual relief. Old age. The old age relief, that's any person that is above the age of 60 years and you are doing or you are earning income. If you're 60 years, the relief that is available to you is 1,500. That's the annual figures available to you. Then if you have aged dependents, your are depending on you, uncle or your auntie or your father or your mother is depending on you, each one of them is entitled to a relief of 1,000 Ghana cedis. So if you have 2 dependents, you can claim a relief up to a maximum of 2 dependents. So for the 2 dependents, you are entitled to a relief of 2,000. Then the disability relief, all those who are disabled in this country are entitled to equal to 25% of accessible income, a quarter of. So the disability is really very big. Somebody who is disabled, once you are able to evidence from Department of Social Welfare that you are disabled, entitled to a quarter, that's 20% of your accessible income as now relief. Cost of training relief, those who are going through apprenticeship or some form, not academic courses, to a relief of 2,400. And then the interest relief or deduction. Went in for a loan from a bank. Once your first residential premises, you went for a loan from a bank and you use that loan to construct your first residential premises. That is where you live with your family, your wife and your children. Any interest on that loan is a relief to that individual. We call it the mortgage interest deduction or the mortgage interest relief. So all individuals are entitled to it. Once you go for a bank loan to build your first residential premises, that is a relief. The entitled to it on a monthly basis. You are entitled to it on a monthly basis. And like I indicated, all individuals are supposed to file their personal returns. So for the individuals, their returns are filed at two levels. Your employer will withhold. When you are an individual and you are in employment, your employer will withhold. And then at the end of the year, 4 months after the end of your business period, you file your personal income tax returns, your PIT. And it's now obligatory on all individuals to file their personal income tax returns. So when the year ends, latest by 30th April 2024, we expect all individuals, whether you are an employee or a sole proprietor or a partner of a partnership, the law says file your returns personally. And for all non-resident individuals, their corporate rate for the individual is 25% on a chargeable income. Bonus payment. Bonus is taxed at the concessionary rate. All bonus payment, those of you who pay bonuses, some of you pay target bonus, incentive bonus, whatever bonus. Bonuses are subject to tax at the concessionary rate. So bonus payment up to 15% of the employee's annual basic salary is subject to a final tax at 5%. But if the bonus payment exceeds 15% of the employee's annual basic salary, then up to 15% is subject to a final withholding of 5%, and the excess is added to the employee's income and tax. Please let me take you to the bonus computation for bonus again. Bonus is taxed at the concessionary rate. So what we do is that when we pay bonus, we compare the bonus with 15% of the employee's annual basic salary. If the bonus payment is up to 15% of the employee's annual basic salary, then the whole bonus payment is taxed at 5%. But if the bonus payment exceeds 15% of the employee's annual, then up to 15% is subject to tax at the rate of 5%, and the excess is added to the employee's income and taxed at the graduated rate. That is the rule on bonus. And then overtime also has a concessionary rate. Overtime payment that is paid to qualifying junior are subject to a concessionary rate, and overtime is generally paid on a monthly basis. So the question you ask is whether the overtime payment is more than 50% of the employee's monthly basic salary or less than 50% of the employee's monthly basic salary. If the overtime payment to a qualifying junior employee is up to 50% of the monthly basic salary, then the whole overtime is taxed at 5%. But when the overtime payment is in excess of the 50% of the employee's monthly basic salary, then up to 50% is taxed at 5%, and the excess is taxed at 10%. Overtime payment to senior officers in your organization is not subject to tax at the concessionary rate. It is only overtime payment to junior officers, qualifying junior officers, that is subject to tax at the concessionary rate. And the law defines a qualifying junior officer as an officer whose qualifying employment income is less than 18,000 a year. So please, you take notes. Gift tax. Gift is subject to tax. Any gift you receive in respect of employment is treated as part of employment income. Gift you receive in respect of business is treated as part of business income. And any gift you receive in respect of investment is treated as part of investment income. So gift is taxable. You just take the market value of the gift, you add it to your income and tax. There is no threshold for gift. There is no threshold for taxation of gift. All gift is gift received. We just look for the market value of the gift and we tax it. For the indirect taxes, we have the VAT, we have the excise duty. So we are done with income tax or the direct taxes. But for the indirect taxes, we have the VAT, the excise duties, the communication service tax, the import duties, and the levies. Basically, the VAT, that's the main contributor for indirect taxes. And VAT is a consumption tax, and it is charged on the supply of goods and services made in Ghana. Goods and services that are exempt. So when you go to the first schedule of the VAT, it gives you the list of goods and services that are exempt. Those ones outside the scope of VAT. Goods and services listed in the first schedule of the VAT falls outside the scope of VAT. The exempt schedule. That is the VAT Act at 870. Any goods or service that is not specifically listed under the first schedule of the VAT Act is subject to VAT. It's subject to VAT. Like I indicated, the exempt goods and services falls outside the scope of VAT and is not subject to tax. The VAT is chargeable on the supply of goods or services where the supply is made by a taxable, where the supply is a taxable supply and it's made by a taxable person in the course of a taxable activity of that person. Basically, and the threshold, the current threshold for VAT is that your turnover should be exceeding 200,000 in any 12-month period. Your turnover must exceed 200,000 in any 12-month period for you to qualify. But if within the first 3 months of the year, there's transactions that Commissioner General has reasons to believe that you be able to make the 200,000 at the end of the year, then the Commissioner General has the power to register you. So the threshold for VAT registration is 200,000 in any 12-month period. You need to disclose that turnover, then you can register for VAT. Taxable activities, yes, the law defines it as an activity that is wholly or partly carried out in the country, whether or not for a pecuniary profit, which involves or intended to involve the supply of goods or services for a consideration, basically that. And for retailers of goods, where your threshold falls between 200,000 and 500,000 for retailers of goods only, then you can charge and account for VAT at a flat rate of 3%. So the VAT is at a flat rate of 3%, where you are a retailer of goods and your turnover falls between 200,000 and 500,000, between 200,000 to 200,000 at the end of any 12-month period, then you can charge your VAT at a flat rate of 3%. Now, this is a typical example of a person who is into supply of goods, an illustration. So assuming that your taxable value or your cost is 1,000 for VAT, and you are dealing in supply of goods only supply of goods. We are not talking about service. We are not talking about exporters or importers or distributors. We are only referring here, this illustration is for supply of goods only. And your threshold falls between 200,000 and 500,000. And your cost, excluding the taxes, is 1,000. All you have to do is to calculate the 1% COVID-19 levy on the cost, which is with 10 cedis. You calculate your flat rate, 3% also on the cost, which is 30 cedis. And so your selling price will be 1040. And if your selling price is 1040, then you will now have to account for the 40 cedis to GRA, because your taxable value includes your overheads and your margin. So you calculate your 1% COVID-19 levy, you calculate your 3% flat rate, and then your selling price will be 1040. And then you now come and account for the 40 cedis to GRA. Sometimes you sell directly, you sold, you do not do the calculation before you sold. When you get your selling price, you can use what you call the VAT fraction to determine the taxes. So for the COVID levy, the VAT fraction is 1/104. It's a flat VAT fraction. It's a fraction. You just apply it to the figure and it will give you the tax, as in COVID-19 levy. And then the VAT fraction for the flat rate is 3 divided by 104. These are flat figures. So don't worry yourself about how did we arrive at these figures. So when you sell something, let's assume that you are selling and you sold a mobile phone for 1,200, but you don't know mobile phone is a good. Assuming you sold it for 1,200, you want to deduct the taxes and come and pay to GRA. You just calculate the VAT fraction on the selling price. So the COVID levy will be 1/104 times 1,200. That will give you the COVID, the tax that you're supposed to pay, or COVID levy. And then the flat rate will be 1/104 times 1,200. For those doing standards, this is how the calculation is done. Standard is input output, and all retailers of goods above the threshold, above the 500,000, wholesalers, manufacturers, importers, service providers, all of them shall account for VAT on a standard rate scheme. And this is how the calculation is done. You determine your cost. That cost is included in, that cost includes your overhead and your margin, but excludes the VAT. Then you calculate all your straight levies, you add it to it. You calculate your 2% get fund, you add it to it. You 5% N-Hill, you add it, your 1% COVID-19 levy. The sum total of the cost plus all the levies will give you the taxable value. And you apply the VAT at the rate of 15%. And what the sum total is what will give you the selling price of the goods. So for those of you who wants to know the mechanics, this is how it is done. Your cost, that cost must include your margin and overheads, plus all the straight levies, the get fund levy, the N-Hill levy, the COVID-19 levy. When you add it to your cost, you arrive at what we call the taxable value. Then you apply the VAT on your taxable value. And then when you add it to your cost, it gives you your selling price. Then you now come and account. You now come and account for all your levies and your VAT. You come and account for your get fund levy, your N-Hill levy, your COVID-19 levy, and then the VAT of 15%. So this is an illustration of the standard. So your cost is 12,000. You calculate your COVID-19 levy of 1%, N-Hill of 2.5%, get fund levy of 2.5%. You add it, you get your taxable value of 12,720, and then when you calculate your VAT of 15%. The VAT is 15%, not 12.5%. The VAT of 15% of the taxable value, and that will give you your selling price. You add all, then you come and account for your VAT. And these are the VAT fraction, the VAT fraction for standard rate. So you just apply it with the same illustration. The other issues that we want to deal with is, all taxpayers could, you have the law provides that you could apply for an extension of time to pay taxes. So if there's any tax you want to pay and you don't have the money immediately, and the law permits you to do an installment payment agreement. to come under an installment payment agreement under Section 47 of the Revenue Administrations Act. So you can apply for an extension of time to pay taxes. Then the law also allows you to apply for an extension of time to file returns. So if your due date for filing returns, like I indicated in my presentation, if you do not file returns on due date, a penalty is computed. And so you could apply for an extension of time to file those returns. Then payment of tax refunds. Yes, a lot of people argue that, I mean, in other jurisdictions, they pay tax refunds, but in Ghana, we don't pay tax refunds. That is not correct. Our law makes provision for payment of refund, but only on one condition. And the condition is that when you pay excess taxes, you have paid more than you should have paid. For example, you are supposed to pay 1,000 and you ended up paying 1,400. Then it means that you have paid excess taxes. Then the law says you can come under the Revenue Administrations Act and apply for a refund. And when it's a refund under the VAT Act, you can come under Section 50 of the VAT Act and apply for a refund. Yeah, so to conclude, Ghana has double taxation agreement with some countries. We have double taxation agreement with UK, Belgium, France, Morocco, Czech Republic, South Africa, Denmark, Switzerland, Italy, Singapore, and so on and so forth. So these DTAs also come into play when a company or an individual is coming from a DTA country. So these double taxation agreements are equally very, very important. We rely on them where we are taxing a company or an individual from a DTA country. We have Singapore, Mauritius, Netherlands, Germany, and all these ones, we have signed treaties with them, double taxation agreement. And anytime we want to tax a company or an individual from a DTA country, we straightforward have to rely on the DTA for purposes of that taxation. Yeah, some of those DTAs are still pending ratification and others are still ongoing. We are still negotiating some others. Yeah, so on that note, I mean, it has been a very lengthy presentation, but thank you so much for your attention. We'll pause here and then maybe we can pick some questions. Thank you very much.
Yeah, I'm happy here. Excellent presentation, excellent delivery from you, Lawrence. Thank you so much for your time. Lots of questions are coming in for you, and okay. Please, my audience, know that he's not the Commissioner General. He's only representing the Commissioner General here. So he cannot grant you any relief or any exemption at this point. Please. Okay. The first question from Philomena Mensi says that, thank you, we'll see you, Philomena. Says, why is VAT taxed on the full cost of the good instead of the value added? It appears to operate as a sales tax. So, Lawrence, let me take three questions and then you respond to them at the same time. Is that okay?
Yes, that's okay.
Okay. So, Philomena says that we tax VAT on the full amount. We should only look at the value added portion and then we tax it on that and not on the full amount. Then, there's one. So, Belinda asked, how would GRA know that I have received a gift? That someone has received a gift? How would you know that someone has received a gift and that gift should be taxed? Then Bright says that I need clarification why there's no. I need clarification. Why is there a need for 1% COVID levy? Why is GRA charging us COVID levy? And then maybe related to Belinda's earlier question, somebody says that Bright says that I really don't understand why we tax gift. So you can explain the gift tax and how you know we have a gift. So let's take these questions and then we'll come back for another round of questions.
All right. Yeah, so just to respond to Philomena, like I indicated when I was doing the presentation for VAT, I indicated that we have two categories, those that are taxed on the flat rate and those that are taxed on the standard. For the standard rate taxpayers, it is on the value added. In actual fact, it is the output minus input. So it is the difference. It's the VAT that you have paid on your sales, on your purchases, minus the VAT that you have paid on your sales. So it is input output. The VAT on your purchases when you were procuring is your input. So any VAT that you have paid when you were procuring the goods is your input VAT. And any VAT that you charge when you are selling is your output VAT. So it is the difference. It is the difference. That is the value addition that is subject to VAT. So the VAT is not the full cost as Philomena mentioned.
So,
The standard
so,
rate is on the value addition is the output minus your input VAT. But those who are doing the flat rates, for the flat rates, I mean that is on the cost of the item. So basically that is that. Like I mentioned, because taxation is a creation of statutes, I mean the law specifically says that the standard rate taxpayers should use the input-output mechanism. Use the input-output mechanism, whilst the flat rate taxpayers will just be on their taxable value. The VAT is calculated on their taxable value. How do
Lawrence,
GRA?
I think that so Philomena is asking the question on two fronts. So, your explanation is perfect for the taxpayer. I'm sure she's looking at it as the end user of the product. So, if I'm the one going to buy the product, what I end up paying is the full VAT amount. But the taxpayer who is selling the thing will now account for it on the input-output mechanism. But the person buying or the end user of the product. So I'm sure that's where the question is coming from.
Yeah, because these are VAT is calculated on goods and services,
Yeah.
supply of goods and services. So if you go and buy let's assume that you go and buy mobile phone, then at that point the person who is selling has the obligation to calculate this VAT on the value of the mobile phone.
Yeah.
And so it's part of the components. And that becomes the person, the one who is selling, that becomes his output.
Yeah.
Are you getting it? But when
Yeah.
he was going to sell the mobile phone, he didn't manufacture it. He also went and bought it from somewhere. He bought the mobile phone from somewhere, and that becomes his input. The tax that he has paid when he was procuring the mobile phone becomes his input. So it runs on input-output mechanism. So at any point in time, the laws will apply. I mean, you calculate the cost, which excludes the VAT. We add all the levies to it. We determine your taxable value, and then we calculate the VAT at the rate of 15%. Then the second question is, how will GRA know I've received gift? The law specifically classified gift into three categories, like I indicated earlier. We have gift received in respect of employment. We have gift received in respect of business. And we have gift received in respect of investment. These things basically are based on voluntary disclosure. But GRA also relies on information from third parties. GRA relies so much on information gathered from third parties. So, for example, if let's assume that there's a donation that is made to a limited liability company, and that limited liability want to use that donation in producing business, then the value of that donation becomes a gift. So we are able to get it from your returns, and we are able to get it. And we get it from the media. I mean, we get this information from the media. So we hear that this person has donated this, and then the next moment we are out there to serve notice. But basically, it is based on a self-declaration, a voluntary disclosure. Yeah, I say, how are we still paying COVID-19 levy? It's purely a policy issue. Yeah, it's policy. So it's policy that determines which taxes you pay and which taxes you don't pay. and it's law, the law that determines which taxes you pay and which taxes you don't pay. So that is my response to why the still 1% COVID-19 levy. It's a policy matter. I am a policy implementer. We implement policy. Yeah, thank you.
All right. So, Melinda, when you receive a gift, please go to the GRA office and voluntarily declare that I receive a gift, and then you pay the tax that you received on the gift. That's it. But for corporates, for those of us who do donations and we announce them, GRA will see you via the media and the announcements. Mind you, the Bible says that what the left hand, right hand does, we shouldn't let the left hand see. So over to you there. All right, Lawrence, there's a question from Frank. Frank says that great presentation. Now continues with the scenario. If I supply a client T-shirt and I'm being deducted withholding tax of 7%, how do we reconcile that? Because I should have been charged 3%. I should have been charged 3%, but withholding tax is 7%. So that's the question. First question from Frank. The next question comes from Bright. Bright says that with regard to double taxation treaty, why is it so difficult for Ghana to enter into agreements with much more countries? He's asking, we have few countries that we have double taxation agreements with. Can we not do that with many more countries? Lawrence, some people are asking for you to share your details with them so they can contact you later. We will come to that at the end of our presentation. The final question, and then we'll take answers from you, is there any mechanism available that is used to determine the capital gains derived on an individual from the realization of a capital asset? Why has the rate been increased from 15% to 25%? What triggered that change? So we're back to you for some answers, Lawrence.
Okay. So let me just start with the third person. The capital gains for individuals. So like I indicated, the law says that when an individual disposes of an investment asset or a capital asset, that individual could elect that the capital gains be subject to tax at the rate of 15%. It's an election. If you do not elect, then we'll tax it using your graduated rate. We'll tax your capital gains using your graduated rate if you do not elect. And basically, it's about disposal of assets, either shares. Like I said, you are disposing of your shares, or you are disposing of your land, or you are disposing of a business asset, which is a capital asset or investment asset. All these ones trigger capital gains. So as an individual, the law says that, well, some of them individuals don't engage in any business. So, I mean, they cannot be subsumed under the business income. And they are not into any employment. So we cannot push it under employment income. So the law says that such an individual, the gift should be treated as an investment gift. So for example, if you decide to buy a car for your fiancé or something, it's not in respect of business and it's not in respect of employment. So it becomes an investment kind of thing, you know. So when it's a capital asset or an investment asset and you are disposing it of, then the gain becomes taxable. You elect and tax it at 25%. The reason why the rate has been increased, originally it used to be 15%. The reason why the rate has been increased from 15 to 25% is that the graduated rate for individuals has also changed. Now the highest marginal rate for individual is 30%. Yes, that's the highest marginal rate for individuals. So it is only fair that when the marginal rate has increased, the withholding rate for the capital gains will also be revised. So it's been revised alongside with the change in the graduated rate for individuals. You say, why is it difficult to have DTAs with other countries? Well, it's purely a policy. I'm aware that GRA or Ghana has a DTA policy. I'm aware that we have a double taxation agreement policy, and that policy determines who and who we negotiate with, who and who we have treaties with. And we take a lot of factors into consideration. The business interest of that company in Ghana. What is the person's business presence? Which benefit will it confer on Ghana? How will it affect our taxes? And so on and so forth. And so, based on that DTA policy, that informs the countries that we select and negotiate treaties with. But like I indicated, there's still a policy issue, which is more or less within the domain of the tax policy unit of Ministry of Finance. Then the question on the T-shirts. So the question there is whether the T-shirt is supply of goods or supply of service. That's the question. Are you engaged in a supply of goods or supply of service? If it's a supply of goods, then it is 3%. If it's a supply of service, then it becomes 7%. There is a thin line between supply of goods and supply of service. For example, printing. So, for example, a printing press, their end products are goods, but generally the printing presses are classified as rendering a service. And then when we take restaurants, the end product is food. Food is supply of goods, but generally we classify all of them as what? Rendering services. Because it's not just the end product we are looking at. We're looking at whether the end product, which one of them is incidental to the other. So in that case, I don't know whether that you are only selling T-shirts. If you are selling T-shirts, then the rate will be 3%. But when you are engaged in a printing press and that whole business is classified as a service, then the withholding rate becomes 7.5%. So it depends on what the questioner is doing. Is it selling T-shirts as goods to consumers? Then the withholding will be 3%. I think that has answered that question too. Thank you. Thank you.
Thank you very much for yes, thank you very much for those answers that you've given us, Lawrence. We'll take next set of questions. Um, okay, so Frank came up for clarity. Says, I purchased the t-shirts, printed and delivered them. So it's talking about because but you see, Frank, even in this question, you said you bought a good t-shirt as goods, then you printed them, which was service, and delivered them. So really, the thin line is still the of what exactly it is.
So the law says that if the supply of goods is incidental to the service, then we should treat it as supply of service. So if the goods in question is incidental to supply of service, we should treat it as supply of service. And if the service is incidental to supply of goods, then we should treat it as supply of goods. So there's a line. We are able to tilt it. We're able to tilt it.
All right. So thank you very much, Lawrence. We'll take a question from Gloria Olingmens. Gloria says that you are talking about okay. So say what they are talking about is good. They are good things. However, we are not seeing the impact on our lives. Look at our roads and environment. Lawrence, I know you are faced with this question a lot in terms of the connection between the taxes that we pay and the impact on the service that is delivered to the citizenry. So you may take that. I've got other questions here. So in your presentation, you talk about commissioner applying best judgment to impose taxes and penalties for failure to file our returns. Why is it important for me to file my return? And I want to talk a bit more about filing our returns because a lot of the time, as individuals and private businessmen, SMEs, we may tend to forget about the importance of filing our returns. And you mentioned that if I don't file my returns, there could be penalty, and the commissioner could use best judgment to determine what else I should have paid and impose that on me. So throw a bit of light on the filing of returns, and it's important. And then if I have to file returns, but for a period, a taxable period, for a business period, I did no work or I didn't get any job to do, or my output was zero, do I still have to file my returns?
All right. So I should respond.
Yes, yes, you have the floor. Please respond.
Okay. So the last one, no work, no income. When you read Section 125 of the Income Tax Act, it says that anyone who has no chargeable income is exempt from filing a return. But the question is, how do we know that you have no chargeable income? How do we know? The only way we can know that you have no chargeable income is if you tell the Commissioner General. That is the only way the Commissioner General can know that for this year, you have a no chargeable income. So if you do not work or you have not any income and so on and so forth, go ahead and file a nil returns. Go ahead and file a nil returns. You know, it is
Okay.
important you file returns because at the end of the day, those of us working in GRA, we don't work in your businesses. We don't work in your shops. We don't work in your offices. We don't know your volume of sales. We don't know your expenditure. We don't know the cost of running your business. We do not have an idea. You are there, you are doing all this business, knowing the cost of running the business, knowing all the business expenses, and so on and so forth. And so it is important to inform the Commissioner General that, look, the business I'm doing, these are my activities for the year. My turnover is 100. All my expenses and my everything is 30 or 70. So my chargeable income is only 30. All the Commissioner General will do is to verify whether indeed your sales or your turnover is 100, and whether indeed all your expenses add up to 70, and whether indeed your chargeable income or your profit is equal to 30. That is all. You know, but when you do not file a returns, it gives room to believe that you are doing something that you do not want to inform the GRA. Anyone who deliberately refuses to file returns, it means that there's something that you are doing that you do not want to GRA to be aware of. And the law has given the Commissioner General the power that anybody that fails to file tax returns, apart from the penalty that you impose, use your best judgment to assess the person. So, for example, Henry, if I'm dealing with you, you are supposed to file your returns by end of this year, and you do not file your returns, I could just use my best judgment. Of course, the best judgment should be guided by the provisions of the Constitution, because the best judgment is discretionary, is the use of discretion. But the law says that the Commissioner General should use that best judgment in determining an income for you. And that income may not be the true picture. And that is why we encourage all our taxpayers to file returns. In actual fact, you go ahead and file. If you have not done anything, go ahead and file a nil returns. And that is very, very important. Or else, when you fail to do that, that is where we impose penalties. Some people, we calculate the penalties before they start running around and looking for amnesty. But why don't you do the right thing? And like I indicated in my presentation, you still even have the right to apply for an extension of time to file if you are out of time. So why
Whoa.
don't you take advantage for that provision? If you are out of time, why can't you just apply for the Commissioner General to give you the permission to extend the time for you to apply? So those are the issues. As to um, whether we are seeing impact or we are not seeing impact, that is a question that I'm not in a position to respond to. I'm not in the position to respond to.
Okay. Thank you very much. Could you I see your question? Slides will be available. Contact your relationship officer at your branch. You get it. If you you drop a message to Sari on our Facebook, or inbox us on our social media pages. We'll get in touch with you on that. Um, Lawrence, we'll take our final set of questions and then we'll wrap this up. For us as small businesses, you talk about allowable deductions. So, what will constitute an allowable deduction for a small business that I've started? I rent a place, I pay electricity, we buy petty things that we use in the office. Sometimes I don't even record some of them because out of pocket we take to buy them. How do we know what is allowable deduction? And then you spoke about under the reliefs. When you talk about the reliefs, you said tax pricing can take for three children. Can both spouses take? So can the man take for the three children, and the wife also take for the same three children? And then Adebola asked me to ask you, what do you mean by non-resident to pay tax? He's an expert, so he wants to understand whether it means expatriating, whether he should pay tax or not. So those are the next three questions. Thank you.
All right, so let me pick the last one. The law defines residency in relation to an entity and in relation to an individual. Now, for entities, any company that is incorporated under the laws of Ghana is a resident company. If you are, it doesn't matter who the owner of the company is. It doesn't matter whether the owner of the company is from Belgium or Nigeria. Once the company is incorporated under the laws of Ghana, that company is a resident company.
Okay.
Then two, the company may be incorporated elsewhere, but that company has its effective management exercised in Ghana. So the company is incorporated elsewhere, but it has its head office in Ghana or its management in Ghana. The law says that company should also be treated as a resident company. So that is the definition of residency for companies.
Okay.
But when it comes to individuals, the law is so clear that when you are an individual, you are a citizen of Ghana, you are a resident individual. But if you are not a citizen of Ghana, let's say you are a Nigerian or you are a Swedish or you are a South African or you are from Denmark or something, once you come to Ghana and you are present in Ghana for an aggregate period of 183 days or more, your status has changed from a non-resident individual to a resident individual. So the law says that it doesn't matter your nationality. You can be a Nigerian, you can be from South Africa, you can be a British. The very moment you come and you live in this country for an aggregate period of 183 days or more, your status has changed from a non-resident individual to a resident individual. So all the privileges that are available to a resident individual, you are entitled to it. And all the taxes, for example, I indicated that for a resident individual, their taxes are calculated from a worldwide source. And so if you are, for example, a Nigerian doing business in Ghana, and you have been here for more than 183 days, your status has changed to a resident individual for tax purposes. And any income you earn wherever, even in Nigeria, will add it in determining your assessable income. So that's about that question. The relief question, if you have 3 children, then it means only one of you that can take all the benefits for all the 3. So if you are a couple and you have 3 children, then you may either decide that, okay, the husband should take 1 and the wife should take 2, because you can okay, let me put it this way. If you have 5 children, then one of the couple can take up to 3, and then the other couple take the remaining 2. So one couple can take up to 3 children, the child education relief. And then if you have 5 children or what, the other couple can take the remaining two.
Okay.
But the two of you, the husband cannot take the relief for 2 or 3, and the wife also claiming a relief in respect of the same children.
Okay.
Yeah. Then, when it comes to the first question you ask, what are allowable deductions? All business expenses that are wholly, exclusively, or necessarily incurred in the business. It means that the expense must relate to the business. The only expenses we do not allow are private expenses. We call it private or domestic expenses. For example, you give your wife chop money in the house, or you pay your electricity bill in the house, or your TNT from the house to the shop, your trotro, I mean the car you take from the house to the shop, and all that. The law classify all those ones as domestic and excluded expenditure, and those ones are not allowable. But all
Mm.
other expenses, interest on loan, repairs, staff costs, and all other legitimate business expenses that are wholly, exclusively, or necessarily incurred in the production of business, the law says we should treat it as allowable deduction. And that allowable deduction, at the end of the day, reduces your chargeable income. So, like I indicated, if your assessable
Mhm.
income is 10 and your allowable deduction is 9, then your chargeable income becomes what? 1. And if you don't, a lot of people, let me just put it this way. You asked a question earlier on. It is only when you file returns that you can. So a lot of people, they are not benefiting from the tax system because they are not filing returns. Because when you file returns, then you realize that by the time we are granting you all your allowable deductions, you only be paying the tax on the chargeable income. Secondly, maybe when you own a building, maybe you are entitled to capital allowance. You can only claim the capital allowance if you file returns. If you do not file returns, who is going to guarantee a capital allowance on an asset that you have not filed returns on? So the filing of return becomes very, very critical. And all these things are part of your allowable deductions. The costs of running the business, all the business expenses that are connected to the business are all granted as allowable deductions. And when it comes to employment, it is reliefs. All the reliefs are treated as allowable deductions for those who are in employment.
Wow, what an exciting and revealing session we've had this morning, Mr. Lawrence Hochunyame, Esquire, Esquire, Assistant Commissioner at the Ghana Revenue Authority. Thank you so much for your time in helping us to understand Ghana's tax regime as relates to MSMEs, and we trust that this will be beneficial to our business and corporates. For those who could not ask their questions or questions were not answered, we're going to go off now, but we will make time to respond to them. If you send your questions, we'll compile them and send to Lawrence and the team. They'll provide us answers and they will engage you. Watch out for the UBA Business Series. There's more coming your way. And I'm sure that you may have heard that UBA Ghana is running our savings promo. We say that open an account or in your existing account, deposit an amount of 300 Ghana cedis or more, and you are going to get instantly 10% interest per annum on your savings. It's that easy. There's no draw here, no chance here. Just put in 300 cities or more incremental on your existing savings account, or put in open a new account and put 300 cities incremental, and you are going to get 10% interest per annum on your savings. It's that easy. You will not find it anywhere. Nobody offers you 10% on your savings, only at UBA. This is available from now to the end of February. And so, what are you waiting for? Rush now and put in that deposit and enjoy the 10% interest on your savings. Thank you all very much for joining us for this session. It's been exciting. And I wish you a very good day. Enjoy the Farmers Day holiday that is coming up tomorrow. and let's together work to ensure that we make Ghana a great place to be in. Thank you very much, and bye bye.